Welcome to the Mogul Rise Podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey there and welcome. This is Augustino. In today's episode, we're discussing a little-known tax strategy called tax segregation. We'll talk about what it is, the benefits, and how it can potentially save you tens of thousands of dollars in a tax return, which will put more money in your pocket and the pockets of your investors. As I said earlier, this is not a very well-known strategy. I think mainly because investors started off in the singles family and small multifamily space. But this tool is mainly used for properties in excess of, like, say, $500,000, $1 million plus. So I invited Yonah Weiss with Madison Specs, based in New Jersey, to discuss what it is and how you can use it as well. Before we get started, though, I really want to make sure to ask you to put a review on iTunes. I respond to all the reviews. I would love to hear from you. It helps make the show that much better for listeners like you, and it also helps with the ratings. I would really appreciate it. So let's get on to the show. We'll get Yonah on to talk about cost segregation, what properties you can use it on. We'll even go through a high-level case study to see how it can actually benefit many investors like you. Hi, Yonah. Welcome to the show.
Thank you, Augustino. It's a pleasure to be here.
Yes. Well, maybe you can tell the listeners a little bit about your background and how you got mixed up in the real estate game, and especially as it relates to what you're doing with Madison Specs.
In cost segregation, absolutely. So I have a teaching background, and I spent many years studying and teaching post-university, post-college, postgraduate. And then a few years ago, a friend of mine was working at a commercial mortgage financing firm, a kind of family office for his uncle. And he asked me to, if I was looking, for something to do, kind of get involved, learn about real estate. And I decided to take him up on the offer and just got my feet wet, jumped in, started learning about everything related to real estate, and was totally fascinated and wanted to just learn more. So it started out in commercial mortgages and financing, and then kind of moved very quickly into real estate, residential real estate, when I got my broker's license, in order just to learn more and apprentice someone who had been in the field for a number of years successfully, which I did. And then I got into, doing seeking out how we can, make money investing in real estate, and partner with someone doing some single family fix and flips, which, got me real firsthand involvement. And most recently, just involved in everything that I've been doing, I was hired by an amazing commercial real estate firm based out of Lakewood, New Jersey, a national firm. They're a title company, a title agency, and they have a number of other services related to commercial real estate, and cost segregation happens to be one of them. They are one of the leaders, Madison Specs, which is the branch of Madison Commercial Real Estate, Madison Title. Most people in the New York, New Jersey area have heard of them and use them. Dallas, Texas is our second largest office out there, and they're huge in that space. So I've been involved in the cost segregation team for about the last year, which we're going to delve into and learn about how this tax benefit helps property owners to save money on their taxes, which is exactly what we do.
Yes, excellent. So now, what are some of the benefits of cost segregation? Maybe we can go into a little bit of that.
Some of the benefits are increased cash flow. Deferred taxes is always a great way to increase your cash flow. It's getting a handle of your portfolio, whether you own one property or several properties. It's a tax strategy to, just allow you to use your money instead of giving it to the IRS to further increase your investment portfolio.
Yes. Yeah. Well, what's amazing about this strategy is that there's still so many people that don't know what this is.
Right. Totally.
Many multifamily guys that I've spoken to, I mentioned this to them, and they said, "Cost seg, what's that?" And mainly because many of these people start off in the single family home business into small multifamily. And it doesn't really apply to the smaller type of properties. But I'll let you talk to that. But maybe you can walk us through like a technical discussion around how does it work? Like, what is involved with all this?
So cost segregation is for a larger, just to give the general background, it's an engineering-based detailed survey of the property, which allows you to allocate all of the assets inside and outside of the property into different categories, different depreciation lives. So each property has a depreciation life, which the IRS kind of arbitrarily gave a number to. So we'll talk about that right now, which is that residential property, whether it be single family or multifamily, has a depreciation life of 27 and a half years. Any commercial property, anything beyond that, whether it be, office space, industrial, hospitals, health facilities, hotels, even retail, you name it, shopping malls, all of that falls into commercial space where people don't actually live for a long period of time. That depreciates over 39 years. So in the traditional sense of depreciation, which is a tax write-off, which is a category on your tax returns that allows you to make a deduction based on the value of your property when you bought it. And cost segregation allows you to accelerate that depreciation. So by breaking up, like I said, breaking up the property into faster depreciation lives, which we'll go into more detail how that works, it allows you to take huge amounts of depreciation in the early years of property ownership instead of waiting 27 or 39 years to take advantage of those deductions.
Excellent. Now, maybe we can walk through a scenario then. So how would an engineering study actually look like?
So the study is a pretty complicated, pretty terse, I'd say. We end up putting out 80, 90 pages of very detailed numbers. It allows the engineer to look at everything within the property and to allocate a value to it, and then to prescribe that value to the tax code, to the Internal Revenue Code, in which they have described depreciation lives or years to those assets. So, for example, let's say you have, some window shades, right? A lot of properties have window shades or blinds, right? A very simple thing that you would think that, you have on all the windows in your building, right? So an engineer will come and take note all of the window shades, all of the lengths, sizes, and every single window that has them, and then take a value, a cash value of what they are, and then say, hey, this stuff depreciates over 5 years instead of 27 years. We're going to allocate a cash value to all of the window shades in the entire property, and then say, okay, now this depreciates over 5 years. That will be one kind of line on this report, which will allow you to then take that deduction of that cash value.
Nice. So basically then in the same vein too, so carpet will, for instance, wear out instead of over 37 years, like a typical depreciation thing as defined by the IRS, you replace it every, say 5 years, you get to write it off over that time period as opposed to the entire 37.
Exactly. So the thing is, the 5 year, I just threw in this number here, 5 years, but actually the IRS established these lives, and it's pretty big category. So you have, basically it breaks down to personal property, what we're going to define as things that aren't part of the permanent structure of the building. And that can be hundreds of different details of things within the property that you wouldn't even have thought of. And that's why an engineer is trained to know what those things are and to allocate them. All of those things depreciate over 5 years. And therefore, you can take that depreciation right off in the first 5 years. So that's going to be really super important. The second category is called land improvements. So this is things in the property outside of the building that depreciate over 15 years. So you're going to be able to take stuff like pavement, right, asphalt, which most properties have, whether it's sidewalk, whether it's parking lot, a driveway, things like landscaping. If you put in a lot of nice flowers or trees planted, things like that, all these things have value and depreciate over 15 years. Signage, fencing. So that's where you're going to get a major amount of value, is by an engineer coming and defining what those things are, what can be depreciated over a faster life, and then prescribe a value to it based on the tax code.
Excellent. You can't depreciate the land itself, but you can depreciate the improvements that are done on it. Sure, absolutely.
Correct.
Oh, that's awesome.
Correct. Which is pretty amazing. right? The land, right? You're always, whenever you buy a property, the depreciable basis of the property is going to be, how much you paid for that building minus a certain percentage that you have to allocate to land. And depending on where the property is located, there are different rules. Different states or counties or cities have defined rules of what kind of property land allocation they'll give. And some are, pretty open and ambiguous, and there can be, as little as 5% land allocation. And there can be as much as, I've seen literally in some cities, 50 or 60% of land allocation. So there's a big spectrum there.
Awesome. Now, one thing you mentioned, I think you touched on it, is the size of the deal, size of the property itself. And it sounds like that segregation is really suited for deals of some sort of size, right? Greater than $500,000 or something. Does that sound right? Yeah.
Right. Usually, yeah. Because again, this is a percentage. It's a proportion deduction. So the bigger the property, the more value spent on the property, the more depreciation you're going to take, and therefore the more potential of accelerated depreciation you can have, right? So the rule of thumb I give is a property worth over $1 million or bought for over $1 million. And that's just because in our experience, and speaking from my company, Madison Specs, who's been in business for 12 years, specializing in this, one of the largest in the nation, have done almost 13,000 properties studies. And usually the larger the property, obviously the more benefit there is. Someone who has a smaller property, they may not see the benefit and therefore not want to take advantage of the studies. So that's why I give a $1 million property. Above that, there's for sure going to be major benefit and definitely worthwhile. Under that amount, there probably will be benefits. When you get closer to $500,000, it's going to get much more nitpicky to see what the benefit is, depending on the individual property. So that's the kind of scale that I give.
Yes. Yeah. Now, what sort of other asset classes does this apply to? I know obviously multifamily is what we're talking about today, but it sounds like this can really apply to just about any other asset class, right? I mean,
pretty much anything that's an investment property. Again, this is not for personal residence. It's for any investment property. But yes, any property is going to take advantage over here, whether it be, and yet there are some that have more value than others, because if you think about it, properties that have more stuff in the building, more personal property. I'll give you an example. Skilled healthcare facilities, right? Skilled nursing facilities. They have tons of what's called 5-year property. So you have stuff like, equipment, beds, specialized plumbing, specialized electric. In each room of this facility, all of that stuff has major tax deductions. And so therefore, you're going to be able to get a lot more bang for your buck when you're talking about skilled nursing facilities, one of our biggest customers. Another great example, which is on the other end of the spectrum, is golf courses. Because golf courses, even though you think about it, is just land, but it's really just land improvements. If you look at it, it's all the grass, and a lot of these places, the professional golf courses, they replace the grass every year or every 6 months or every 2 years. So that stuff is going to be depreciated at a much faster life. A lot of landscaping going on there, so much so that up to 80% of the value of a golf course can actually be written off over a 15-year period.
Wow. That's huge. My God. Wow. Now, I guess, what would you say it's less suited for? Like, what would be a scenario where you would tell like a multifamily owner, even a big multifamily owner, that this is probably not a good idea for them to do?
Multifamily is almost always a good idea to do. When you're talking about city properties, for example, we just did a big building a couple weeks ago in the Bronx in New York. There's almost no land improvement whatsoever. There's almost no 15-year property. There's a little bit of sidewalk, but that's about it. So the major amount of deductions are only going to be within the first 5 years for the personal property in the building. So city properties are going to have less 15-year deductions, but garden-style apartments, which are much more common in the South and the Midwest and basically everywhere else besides for the big cities, they're going to have much more 15-year properties. So it's going to add up to the total amount of deductions. But smaller properties, let's say single family or a small multifamily, let's say a 2-plex, 4-plex, are going to have less benefit just because if you think about it, it's just a numbers game, right? In a multifamily, you have 200 units, you're going to have 200, dishwashers or whatever, 200, light fixture systems, right? In a single family, there's just one. So even though the same property, right, you're going to buy for the same price, a really big luxury single family property you buy for, let's say $1 million, is not going to have the same tax benefit as a 100 unit. I don't know if you can get that anywhere, but let's say a 50 unit property for $1 million, out in the boondocks, right? You're going to get that property, but you're going to have 100 times, probably at least to a certain extent, 100 times of the tax benefit in that multifamily property.
Yes. Excellent. Now, are you able to maybe go through like a quick case study analysis? Like say, if there was like, say, $1 million property, what would be the benefits of cost seg versus not, like in terms of savings? Like if we go through some real numbers.
Yeah, sure. Absolutely. So let's just do the numbers. Like we said, cost segregation, you have to automatically take a amount and allocate that to land which does not depreciate. Okay, so let's just take a round number of 20%. Okay, so you're left with $800,000, which is going to be depreciating. Okay, now if you didn't do cost segregation, all right, and you just took it, and then we're going to talk about a multifamily property here. You bought for $1 million. You're going to take the depreciation based on an $800,000 value. Let's say you didn't do cost segregation and you just did the straight line depreciation. Okay, so you're going to divide that 800,000 by 27.5. Okay, and you're going to get on your tax return $29,000 of depreciation deduction each year for the next 27 years. Okay, that's a very round number. Okay? And that's great. That's awesome. That's one of the benefits of real estate. You get this stuff. Now, what happens if you do cost segregation and you want to get maximum benefits within the first 5 years of ownership? So what you do is the engineer will come down, he'll survey the property, he'll take, the amount of land improvements, he'll take the amount of personal property, divide it up into categories. Oh, and by the way, before the engineer goes to the property, what we'll do, and most cost segregation firms will do, is provide a free complimentary feasibility analysis. That's just an estimate based on our vast experience of taking a look at some of the details of your property, where it's located, what the square footage is, what kind of property it is, and tell you our projection of how much tax savings you're going to get. So based on that, you can usually make a pretty educated decision whether or not to go through for the full study and pay the company to prepare this full study. But once you do that, we're going to take a number. Let's give a round number. All right, I'm going to be very conservative over here, and 10%. Okay, we're going to take 10%, which even though multifamily property is usually going to be between 10 and 30% of the value of that is going to be cost segregated and get extra benefits, we're going to be on the conservative side. You got a cost segregation expert to come and take 10% of that value through the study of 800,000, going back to our original number, and depreciate that over a faster life. Okay, that means an extra $80,000 you're going to be, deducting from your tax bill over the next 5 years. So that $80,000 of extra tax benefits divided by 5 years, that's an extra $16,000 per year, right? Add that to your 29. And, listen, it's not a huge amount. You're going to be ending up saving $45,000 instead of $29,000. So on a small property and on a very conservative basis, right, that's going to be. But what happens if he's going to find 30%, which is pretty common with multifamily properties, of 20 to 30% of that value? You're talking about a huge amount. We're talking about $48,000 per year of extra tax deductions. And that goes a long way.
Wow, that's amazing. I mean, this thing will pay for itself after the first year, basically.
It pays for itself in the first year, absolutely. And, just think about it on a larger scale, right? We're, buying a property for $10 million. We're buying a property for $100 million. We're buying a property for $1 billion. I mean, most people don't think about that when they're buying a property for $1 million, not thinking about when am I going to buy my $1 billion property, right? But, there are companies, and there are a lot of them out there that are doing that. And, huge multifamily, huge real estate firms, and they're they're getting major tax benefits along with every purchase that they do.
Nice. Wow. Amazing stuff. Just amazing stuff. Now, what does the overall process look like? Is it like an invasive procedure? Is the engineer going to go in there and start tearing down walls and going through, lifting up carpets and stuff like that?
Not at all. The only amount of invasiveness is his presence being there, which is a pretty short process, but it involves, just taking a survey, taking pictures, some video, documentation, and that's about it. And the great thing about a multifamily property is that since the units are pretty much the same, like you'll have a 100-unit building, but some of them will be 1 bedroom, some of them will be 2 bedrooms, some of them will be 3 bedroom. So the engineer, there's a law that allows him to actually just to go in for this purpose into 1 or 2 of those sample units, and then use those findings to apply to the rest.
Oh, nice. Excellent.
So multifamily is one of the easiest to do in cost seg. Easiest work, something like an office building or a shopping mall, right, is going to be a lot more detail because every single unit is going to be different. And so the engineer is going to need to go into every single one and take a lot more detail.
Yes. Now, so what does the output look like when it's done? Is this something you just hand off to a CPA and that's it, or?
It's as simple as that. And we work together with accountants to provide this service. So we'll prepare a depreciation schedule, an updated depreciation schedule instead of straight line. We'll get the Excel file ready and hand that over to the CPA, and then we'll prepare the full report, put it on a disk, and then you submit that with your tax return. You're good to go. The IRS, since this was established and recommended by the IRS to do, there's no red flags here. You don't need any. Someone asked me last week, actually, do I need permission from the IRS to do this? No. They initiated this, they established this, and they provided all the rules, something called the cost segregation audit guide, right? And there's a whole system to doing this that if held to and abided by, you're doing everything according to what they want you to do.
Nice. Excellent. So, it seems to me, though, that with a detailed engineering study like this, and you guys are assigning values to the individual components, you can actually use that to determine reserves if you're going to do a new purchase. Has anybody ever done anything like that? Or is it a feasible thing?
Yeah, people do that. People, put that into their pro forma. They'll put that into their business plan. And that's why a lot of people like to get this done even before closing. A lot of times people like to get this done, or at least get this study done as soon as they buy a property. So they're going to have their business plan, ready to go, show their investors even before closing. This is what I'm planning on doing. This is going to give us more cash flow. And that's amazing.
Yeah. Sometimes I even like to do the cost seg afterwards, and it would just be an added bonus that they weren't even expecting.
Absolutely.
That's just what I personally do. So that's amazing stuff. Now, how do you handle like repairs versus improvements in those scenarios? Where you say they're adding brand new upgrades of bathrooms in 100 units versus just fixing the faucets or something like that.
So any upgrades that you're going to do, you have the option to then go ahead and depreciate the new item. First of all, write off whatever you disposed of from a value perspective, and then the new assets that you're going to be replacing them with, you can actually use that to do a new cost segregation. If it's a huge amount, it may be worthwhile to get an engineer to come in and prescribe value to all that so you can re-depreciate that over a faster life.
Nice. Amazing stuff.
Which now with the new tax law, which maybe we'll touch upon, maybe not this time, what's called bonus depreciation, where you can get in the first year, you don't actually even have to wait 5 years anymore. You can decide to take all of that depreciation that you would have taken over 5 and 15 years in the first year.
Excellent. Wow. Amazing stuff. It really is. Just amazing stuff. Now, tell me about time limits. Is there a time limit you can do a cost seg analysis? Like if I held on to a property for like 10 years and just like we talked about at the beginning of the show, someone realizes, oh, wow, I could do a cost seg on this. Are you kidding me? That's amazing. Is it retroactive?
You can do it retroactively, yes. So one of the things that people ask, a common question is, well, I never did this. I never knew about this. can I still do this, like you're saying, on a property I bought, 5 years ago, 10 years ago? The answer is yes. And they'll say, well, I don't want to go up and open up my previous year's tax returns. I get it if I'm going to do it from now onwards, but how do I do that and get the benefits retroactively? And that's something, there's a form that's called 3115. It's a form that is a tax form that goes together with your tax return. And it's something that allows you to change the way that you've depreciating your property. And this is no commission or consent on doing this. You don't need permission from the IRS to do this. You can decide whenever you want to go ahead and change the way that you've depreciating your property. But important to note, you can't go backwards. You can't say, I've been doing it the cost segregation way and I want to go back to the straight line. That's the one disadvantage. You can't go backwards. You can only go forwards, I guess we'll say, and change that. So what that does is it says, I'm going to look at this property and look back, and we call it a look back study. That's our kind of coined way of saying it, that you can look back and see all of the tax benefits I missed over the last 10 years and catch up and get them all. And what happens is you're going to get a huge, huge, huge boost in that first year.
Excellent. I guess to touch on something you just mentioned, under what condition would someone want to do a look back to even try to go straight line? I mean, I guess if they're losing money, right? I mean, if they were losing money, this will accelerate the loss, I would imagine, right? Unless I want to take it on the personal, maybe that could be a strategy. That's a whole other ball of wax, it sounds like, right?
Right.
Yeah. Excellent. If somebody wanted to get a study going like today, what would you need to at least, I guess, come up with a proposal or come up with a rough idea as to what you can possibly do for them?
Absolutely. So if it's a large commercial property, we just need some very basic details, and then the rest we can get from public records. And so what the details we would need, and like I mentioned before, we'll prepare a free estimate, and most companies will. Based on these details, we'll need the address of the property, which allows us to pull some public records to get more details like square footage and how many units, when it was built, stuff like that. We don't need all that information from you. The address is usually enough. And then the place and service date, which is usually the day that you purchased that property, unless it was not ready for rent yet. And therefore, the place in service would be the day that you place it in service, meaning the day that people start renting it out or ready for rent. So we need those two things and the purchase price so that we can properly establish or determine the depreciable basis of the property. So three things: address, place and service date, that's the purchase date usually, and the purchase price. With those three things, we can get you an estimate and tell you can look at those numbers, see if it makes sense, run it by your accountant, see if it makes sense for your overall tax strategy, which it doesn't for everyone. So we allow you to make that educated decision and see the numbers. And once you do that, most people decide, hey, why in the world would I not do this?
Excellent. I mean, it's such a great tax strategy to save yourself some money and pass on a lot of profit to the investors too. Just amazing stuff. Amazing stuff. Now, if somebody did want to get this done, how can they reach you?
Yeah, you can find me on LinkedIn. That's a great place to find me. I think that's where we connected first, Agostino. And my number, direct line, is 732-333-1477. You can reach me by that anytime. Email yweiss@madisonspecs.com. You can put that in the show notes if you want or whatever. And yeah, absolutely. Reach out. Happy to do that estimate and see if it makes sense for you.
Excellent. Great. Well, you know what, Yonah, thank you so much for being on the show today. It was great speaking to you, and I think that this is such a great strategy that people just need to start using. This is just amazing stuff.
Thanks so much, Agostino. It's been a pleasure, and anytime.
Thanks again, Yonah, for educating us on cost segregation. I hope you guys can see the amazing benefits of this great tool. It's definitely worth looking into, as you don't want to leave money on the table. You will more than recoup the cost of the study in the first year alone. If you have a property that is $500,000 in value or even more, there is some taxable, and there is taxable income on the property, then you can definitely get a free analysis with Yonah. His contact info will be in the show notes, as well as the phone number he left in the actual recording as well. If you send him those three pieces of information, the address, the purchase price, and the purchase date, he could do a free analysis and tell you how much money you can save on your taxes. I truly hope that this was helpful for you guys, and I'll see you next time.
Thank you for listening. We hope you enjoyed the Mogul Rise podcast. For more free podcasts, articles, videos, and resources, go to www.mogulrise.com.